Hello everyone and welcome to a new video in my series where we learn about technical analysis in bite-sized chunks. So today we're going to be looking at different types of charts and the advantages and disadvantages of each one. The first chart that we're going to look at is the line chart, and this is a chart that everyone has seen at one point or another in their lives. It's a chart that simply connects the closing prices. These charts usually do not put any volume. They also don't show the intraday movements. The line chart is also called the economist's chart. Why? Because it is used to study long-term trends, seeing as you don't care about the intraday movements, it's just the closing prices. The advantages are that it's easy to understand, easy to construct, and easy to maintain. These charts aren't very cluttered, seeing as we don't have the intraday movements. However, the disadvantage is that there is a lot less data. It does not give the exact time of a trend change or of a certain price movement. Then the next chart that we're going to look at is the bar chart. Now, each line has a certain way that it's constructed. So the left tick represents the open price, the actual bar in between represents the movement, and the right tick indicates the close. And each interval is represented by one bar. Bar charts usually have volume, and nowadays TradingView does display colors when it's a green bar or a red bar, but normally and in the past they don't display the colors. So that is, or it used to be, a disadvantage of these bar charts. A bit less easy to read, a bit harder to maintain, and it requires more space, especially if you're doing it by hand. However, the advantages are that it can give you a better sense of direction, you have a lot of precision, it's more versatile, and the volume is usually included in these charts. Oh, and in terms of definitions, the difference between the high and the low is called the range. The next type of chart that is perhaps the most popular and most widely used chart nowadays is the candlestick chart, otherwise known as Japanese candlesticks. These include the OHLC, meaning the open, high, low, and close, just like in the bar charts. Now with TradingView, you see that a green candle is an up candle that closes up, and a red candle is a candle that closes down. But back in the day, we only had black and white, so an up day was seen as white, a down day was seen as black. The rectangular box that you see is formed by the open and the close price, and so if it's an up day, you can infer that the bottom part is the open, and the top part of the rectangular box is the close price. And this is called the real body. That's the definition of that rectangular box. Next up in terms of definitions, we have the shadow, which is the little line off the top and off the bottom of the candle, which show the price extremes of the session. Now, the advantage of Japanese candlestick charts is that it is more visual. It's very easy to see positive and negative trends. There is a lot of detail in these charts. The disadvantage is that it's harder to calculate by hand, and if you want to be a pro, you need to study the patterns. The patterns will be covered in an upcoming video. The next chart I want to talk about is the point and figure chart. Now, this is a very obscure chart that not a lot of people use. It's more for purist technicians, and it's also mostly used in continuous markets like commodities or currencies. Another characteristic is that it's mostly also used in liquid markets. And it's kind of a weird chart because it actually ignores time, it ignores volume, and it only solely focuses on price. Everything else is considered noise in these charts. And so in these charts, we're not going to dwell too much time on it, but in these charts, an X represents a price move up, an O represents a price move down. So essentially, in a certain time frame, you will see X's all the way up in a vertical line until it goes down. And then when it goes down, you switch columns and you do O's all the way going down until the direction changes. Now the box size represents the dollar amount representing one box. And the smaller the box size, the more sensitive the chart is. Makes sense. Next up, the reversal size is how many X's in a row that we have versus O's, and vice versa, when the price is to reverse. Now the advantage of PNF charts is that the information is compressed. It's very easy to spot the resistance and support levels, and it could be used for specific purposes, for things that only consider price and not time. But that's also one of the disadvantages. It doesn't use time nor volume. So I'll admit it's kind of a weird chart. Not a lot of people use it. It's very much of a niche type of thing. The last two charts that we're going to look at aren't necessarily a type of charts. They're just a way of looking at all of these charts we were just talking about, which is arithmetic versus logarithmic charts. And so there you go, that pretty much wraps up the video. I hope that you found it useful, and if you did, I would really appreciate a like from you. Thank you so much for watching.